Welcome to the deep dive. Today we're digging into AT&T's second quarter 2025 earnings call.
Yeah, lots to unpack there.
Absolutely. Our mission, as always, is really to equip you, the experienced investor, with a clear, concise read on their performance, their strategy, and, the outlook.
Right. We're talking numbers, strategic moves, and what it all kind of means.
Exactly. So let's dive in.
Okay. Well, fundamentally, it was a very strong Q2 for AT&T. They largely beat expectations, setting a pretty solid tone for the first half of the year.
Strong how? What are we seeing?
Well, when you look closely, it really signals that their disciplined strategic focus is starting to pay off meaningfully.
Okay, let's start with that snapshot then, the results. Because they did seem pretty impressive on the surface.
They were. Consolidated financials showed pretty healthy growth. Total revenues and adjusted EBITDA both climbed about 3.5% year over year.
And that top-line growth, did it translate down?
It did. Adjusted EPS saw a bump, up about 6% to 54 cents. That's up from 51 cents last year.
So what does that suggest about, their operational efficiency this quarter?
Well, it points to improved leverage, definitely.
Yeah.
Better profitability, which, is critical for investors looking for sustainable earnings.
Yes. And cash flow. Always key.
Absolutely critical. And for those watching cash flow, free cash flow, or FCF, it rose significantly. It's $4.4 billion, up from $4 billion the year before.
Okay. And CapEx, were they spending heavily?
Capital investment was $5.1 billion, so a modest increase year over year. Shows they're still committed to network upgrades, but keeping it disciplined, not overextending.
Got it. So solid financials, but it's not just the spreadsheet, right?
Yeah.
It's about customers. Any standouts on the subscriber side?
Yeah, that's where the story gets pretty interesting. AT&T added over 400,000 postpaid phone customers in mobility. That's a key metric.
Over 400K, yeah, that's solid.
Very solid. And fiber subscribers also showed impressive growth, 243,000 adds there.
Okay.
But the real kicker, maybe the clearest sign of a strategic shift, was Internet Air.
The fixed wireless play.
Exactly. Additions reached 203,000. That pushed them to nearly 450,000 new subscribers for their most advanced broadband services combined.
Wow, 450K between fiber and air.
Yeah, and get this, it means they tripled their quarterly total broadband net adds in just 1 year.
Tripled. Okay, that's definitely noteworthy. So based on these top-level numbers, sounds like they're feeling pretty good about hitting their full-year guidance.
Absolutely. These numbers show solid execution, and management sounded quite confident about reiterating their full-year consolidated financial guidance for 2025. It suggests they've kind of hit their stride.
Okay, those high-level figures paint a promising picture. But, the real story is often in the details. Let's peel back the layers a bit, starting with mobility, the core business.
Right.
They mentioned the wireless environment saw increased activity, and they expect that to continue. How did that play out in their numbers?
Well, mobility service revenue grew a solid 3.5%, and EBITDA was up 3.2%. Pretty steady growth there.
And those postpaid phone ads, the 401,000.
What's interesting there is that figure was actually ahead of their own internal expectations.
Oh, really?
Yeah, and it was fueled by a big jump, more than 20% in gross ads compared to last year. That represents a significant influx of new, high-value paying customers.
High value. That's the key phrase, isn't it? Focusing on quality.
Exactly. For an investor, focusing on high-quality gross ads is crucial for long-term ARPU, average revenue per user, and lifetime value.
Right. Now, speaking of value and keeping customers, there was a slight uptick in churn, wasn't there? Postpaid phone churn up 17 basis points to 0.87%. How should we read that? A warning sign.
Yeah, it's important context. Look, the increase was primarily driven by customers reaching the end of their device financing deals. And like you said, just more activity in the market overall.
So predictable factors.
Somewhat predictable, yes. And the company expects seasonal patterns anyway in the back half, with new device launches coming up. That always stirs the pot a bit. Crucially, though, despite higher costs for acquiring and retaining customers, their focus remains on adding those high-value ones. It's a strategic choice. Prioritize quality, even if it means a bit more near-term spend.
A trade-off.
A calculated trade-off. And it's reflected in the guidance update, too. They actually raised their full-year mobility service revenue outlook to 3% or better. That's up from the high end of 2% to 3%.
Okay, so more confidence on revenue.
But on the flip side, they adjusted the mobility EBITDA growth guidance slightly down to approximately 3%. That was from the high end of 3% to 4%.
To account for that higher spending on growth.
Exactly. Reflects the higher near-term growth-related spending. leaning into growth.
Got it. Okay, let's switch to broadband then. Fiber and internet air. Consumer wireline looks strong overall.
Very strong. Total revenue up 5.8% year over year. And that was largely driven by really impressive growth in fiber revenue, up almost 19%.
19% fiber revenue growth. Wow. And the net adds.
The 243,000 fiber net adds were slightly up year over year. Q2 is usually a bit slower for subs growth seasonally. They expect higher adds in Q3.
Makes sense.
But what's really significant here, I think, and a major strategic advantage, is how their fiber and 5G convergence rate is accelerating.
Getting customers on both wireless and fiber.
Exactly. That rate hit 40.9% by the end of Q2. That's a 70 basis point jump from Q1 and 140 basis points year over year.
So almost 41% of fiber customers also have AT&T wireless.
Right. And that indicates customers are increasingly choosing AT&T for both, which, as you'd expect, means lower churn, better lifetime values. It just creates a stickier customer.
Yeah, that makes a lot of sense. Okay, and then internet air, you mentioned the big jump there. Over 200,000 ads in the quarter?
Yeah, first time ever over 200K in a quarter. It brought the total to over 1 million consumer internet air subscribers.
1 million subs already.
How significant is this ramp up? What's the strategy behind pushing fixed wireless so hard? Well, this growth isn't just a number. It kind of fundamentally refines their broadband strategy. It's about monetizing their wireless network more efficiently.
Right.
Using existing assets.
Exactly. And it's a clever funnel for future fiber conversions. Plus, it's a direct challenge to cable, especially in areas where fiber isn't deployed yet.
So competing where they couldn't before, essentially.
Right. And this quick ramp, they attributed it to their wireless network monetization efforts and having more mid-band spectrum coverage. That's key.
So is it fiber or internet air? Or both?
Their strategy is still fiber first. That's the premium top-tier solution. But internet air is increasingly being used strategically. In areas they plan to build fiber later, it gets customers onto their broadband platform now, then they can migrate them easily when fiber arrives.
Smart. A placeholder and a competitor.
It's a very flexible, converged network vision. And again, look at the guidance. They raised the full-year consumer fiber broadband revenue growth to mid to high teens, up from mid-teens. And consumer wireline EBITDA growth outlook also increased, now low to mid-teens, instead of high single to low double-digit.
Clear momentum there. Okay, let's shift gears one more time to business wireline. Historically, that's been tougher sledding. How did it do?
Actually, it outperformed their initial expectations this quarter, which is interesting.
Why was that? Still declining, right?
Oh, yeah. Revenues declined 9.3% year over year, EBITDA down 11.3%. But the outperformance relative to expectations is a good sign, I think. For investors, it suggests maybe the drag from those legacy services is easing up a bit faster than feared.
Freeing up resources quicker.
Potentially.
Yeah.
It was mainly due to slightly less pressure from legacy services and, importantly, strong execution on cost cutting.
The efficiency angle again.
Right. Operating and support costs were down nearly $275 million year over year, mostly lower workforce and contractor costs. And they noted some of those savings will be reinvested into growth areas like fiber and advanced connectivity.
Managing the decline efficiently.
Exactly.
Yep.
So their full-year business wireline EBITDA decline is now expected to be in the low double-digit range. That's better than the mid-teens decline they initially guided for. Speaks to that operational discipline.
Okay. So that wraps up the segments. Let's go back again to the bigger picture, the investor context, strategic pillars, the macro view.
Right. And a major theme on the call, frankly, maybe a game changer, was the impact of recent legislation, pro-investment provisions.
They sounded quite positive about that. Significant tailwinds, they called it.
Significant is right. I mean, look at the plans this enables. They're talking about accelerating fiber deployment to a pace of 4 million new locations per year.
4 million a year. That's fast.
That's the run rate they expect by the end of 2026. And it positions them to reach around 50 million customer locations by the end of 2030.
50 million.
Or, get this, over 60 million fiber locations, if you include the Lumen Mass Markets assets they acquired and open access deals.
That basically doubles their fiber reach from the 30 million they just hit.
Exactly. They hit 30 million ahead of schedule in Q2, and now they're aiming to double it. These legislative tailwinds, they really de-risk and speed up that huge capital investment in fiber. It gives them a major scaling advantage.
And potentially lowers the cost of capital relative to others.
Could do, yeah. The legislation also creates a pipeline for mid-band spectrum, which is crucial for handling all the data demand down the road.
Right. And you mentioned managing decline. They're also actively retiring old copper.
Big time. They reported progress there. filing to discontinue service in about 10% of their old wire centers across 17 states. The goal is ambitious: discontinue service across the large majority of the copper footprint by the end of 2029.
Streamlining operations, cutting legacy costs. Makes sense.
Huge shift.
Okay, moving to capital allocation, financial flexibility. Balance sheet still looking strong. Leverage, okay.
Yep. Balance sheet remains solid. They're operating within their target leverage range, around 2.5x net debt to adjusted EBITDA, ending Q2 at 2.64x, so right in the zone.
And the DirecTV sale, that cash coming in.
The sale of the remaining stake closed in July. There's still over $4 billion of the original $7.6 billion in cash proceeds remaining, mostly expected in 2025.
Okay, but the really big news on the financial front seem to be taxes, right?
Oh, absolutely.
Yeah.
This is where it gets really interesting for flexibility and shareholder value. Because of these new tax provisions, they expect to realize somewhere between $6.5 billion and $8 billion in cash tax savings just between 2025 and 2027.
6.5 to 8 billion.
Billion, yeah. To put that in perspective, cash taxes will be lower by $1.5 to $2 billion in 2025 alone, then another $2.5 to $3 billion lower in each of 2026 and 2027 compared to what they previously thought.
Wow, that's a fundamental shift in their cash flow profile.
It really is. It's not just a minor tweak. It significantly enhances their financial maneuverability, de-risks those big capital plans.
So what are they planning to do with all this extra cash, this war chest?
Well, a good chunk goes right back into the strategy. They're accelerating fiber deployment even more, an extra $500 million in 2025, and then a combined $3 billion across 26 and 27.
Putting the savings to work on the build.
Right. They're also shoring up the pension plan, contributing an extra $1.5 billion by the end of 2026. That gets it to about a 95% funded status.
Okay, responsible use there. What about the rest? Does it just flow through?
The remainder drops right to free cash flow. So their full-year FCF guidance for 2025 is now trending slightly ahead in the low to mid-$16 billion range. That's better than the $16 billion plus they said before.
And looking further out.
For 2026 and 2027, they're expecting about a $1 billion upside to their annual FCF guidance each year.
$1 billion extra free cash flow per year. That's huge.
It is. And that enhanced flexibility supports everything: strategic investments, more capital returns, paying down debt faster. It's a clear win for the balance sheet and for optionality.
And speaking of capital returns, shareholders directly benefit how?
Through buybacks. The company intends to accelerate share repurchases. They're targeting $4 billion in buybacks by the end of this year, under their existing $10 billion authorization.
$4 billion by year-end. That's a pretty strong signal of confidence in the stock price.
Definitely. Management sounded very confident overall. Strong belief in their strategy to be the best connectivity provider. They feel the consistent, disciplined investment is really starting to pay off.
And they see a path to faster growth, better margins.
Exactly. Higher operating leverage and eventually lower capital intensity as these big network builds mature. It's that long-term vision finally taking shape.
It was interesting hearing them talk about the industry being at a seminal change point, AI, the need for consolidated networks.
Yeah, they see that playing directly into their converged strategy, having both strong fixed and wireless networks under one roof.
And they really emphasize the policy tailwinds stronger than anything in decades, even the '96 Telecom Act.
That was a bold statement, wasn't it? But it highlights just how favorable they see the current environment for investment, spectrum access, and maybe deregulation.
So despite potential macro headwinds, they mention monitoring things like public sector spending, immigration impacts on prepaid, tariffs, they feel pretty well positioned.
That was the message. They feel well equipped to manage through those things. And their broadband strategy, with both fiber as the top-end solution and Internet Air hitting other segments, they see that as letting them win across the board.
Covering all the bases, essentially.
Pretty much.
Okay. And that brings us to our not financial advice segment. Remember, everyone, this is purely for discussion, for sparking ideas, not a recommendation.
Definitely not advice. But given all this, the cash flow boost, the accelerated fiber plans, the buybacks, it does raise a provocative question.
Which is?
What does this mean for the smaller players, the regional fiber guys?
Right. In a game where scale and capital are becoming so critical.
Exactly. And where fragmentation can be a real weakness. So here's an outrageous but plausible trade idea that kind of emerges from the call's subtext.
Okay, let's hear it. The opportunistic consolidation arbitrage play.
You got it. The idea is go long AT&T. Because of the amplified free cash flow, The
Yeah.
buybacks, the clear intent to double that fiber footprint, they have the muscle.
Okay, long AT&T. And the other side.
Simultaneously, short a carefully chosen basket of smaller, highly leveraged regional fiber overbuilders, specifically in geographies where AT&T might look to expand or consolidate.
So the logic is AT&T, flush with cash from operations and these tax savings, is perfectly positioned to snap up some of these stressed players at a discount.
Precisely. Management even hinted at it, noting that many overbuilders are, quote, not entirely well capitalized and could struggle.
Creating a buyer's market for AT&T.
Potentially, yes. A fertile ground for opportunistic, value-adding M&A. AT&T enhances its scale, reduces competition, and potentially doesn't have to overpay. You're essentially betting on AT&T's financial strength and patience winning out in a consolidating market.
Strategic patience meets market vulnerability. Interesting angle.
Again, just a thought experiment, not advice, but it reflects the dynamics at play. The big guys with capital look set to benefit.
Okay, let's wrap this up then. AT&T's Q2 2025 call. Strong execution, clearly. Big focus on strategic investment in fiber and 5G. And a pretty massive boost to financial flexibility from that tax legislation.
Yeah, the narrative isn't just meeting expectations. It's about a giant leveraging policy and discipline to really accelerate its transformation, becoming that converged, scaled network provider they keep talking about.
Key takeaways seem to be speeding up fiber deployment way beyond prior plans, strong sub-growth across mobility and broadband thanks to that converged strategy.
And a clear path to better shareholder returns, more free cash flow, faster buybacks. The whole strategic vision just seems to be gaining real traction, helped by this favorable policy environment.
Absolutely. So remember, the insights we shared are for informational purposes, definitely not financial advice.
Please don't trade based on our musings.
But think about it. What stood out most to you from all this? As AT&T pushes harder on fiber and 5G and has more cash to play with, how will that reshape the competitive field, especially for those smaller regional players over the next, say, 2 or 3 years?
Yeah, lots to mull over there. The ripple effects could be significant.
We encourage you to keep exploring the implications for the telecom sector and really beyond. Thanks for tuning in to the deep dive.
We look forward to our next deep dive with you.